Hello! Global equity funds just took in a wave of money as headlines framed it as investors relaxing about AI. But the strange part is this: the flows and the market's leadership patterns don't read like a simple "AI is fine now" story. By the end, you'll know what stocks were actually reacting to, and you'll know what could flip that mood next. Start with what happened. In the week to February 18th, global equity funds pulled in about $36.33 billion. Europe took in about $17.22 billion. US equity funds added about $11.77 billion. Whatever the label, that's a real swing toward risk. People were willing to own stocks again, not just hide. One quick caution before interpretation: flows are an echo, not a heartbeat. They confirm a mood after it starts, and they can lag the actual turning point. So the right question isn't, were inflows big? It's, what kind of risk did investors choose to own, and what kind of risk did they step away from? That's where the regime hides. Now slow down and look at the composition, because composition is where narratives usually crack. In the US split, value funds took in money and growth funds saw money go out. That's not a moral judgment about value or growth. It's a clue about what investors think is being repriced. If the market were purely celebrating the AI story, you'd expect the long-duration growth bucket to be the obvious magnet. When the opposite shows up, it's a reminder that risk on can mean something broader and more mechanical than a single theme. There was also a macro backdrop to the mood. US CPI in January was reported at 2.4% year on year, and that kept the market leaning toward the idea of rate cuts later this year. The important point isn't whether 2.4 is good or bad. The point is that it influences the path investors imagine for interest rates, and that path is one of the strongest levers in equity valuation. That's the tension in plain language. The public story says AI fear is cooling, so money is coming back into stocks. The market story can be different. Stocks can rise because investors think future profits will be bigger, or because the discount rate used to value those profits is falling, or because the probability of a scary scenario is being priced lower. All three can happen, but usually one dominates. If you mix them up, you end up chasing the wrong explanation. So here's the translation. For this episode, the key variable, the thing equities truly care about, is the expected path of the discount rate. It's the hurdle rate investors use to turn future cash flows into a price today. When that hurdle rate feels like it's coming down, equity prices can lift even if the underlying story hasn't materially changed. This is easiest to feel with a simple thought experiment. Imagine a company whose profits arrive mostly later rather than sooner. If you have to apply a high hurdle rate, those later dollars shrink a lot when you translate them into today's value. If the hurdle rate falls, those same later dollars suddenly matter more. Nothing about the company changed. The math changed. That's why rates are so powerful for long-duration stories, and AI leadership is often a long-duration story. You're not paying for what exists today. You're paying for what the future might look like. If you want a more everyday analogy, think about a house. The house can be the same house in the same neighborhood, and yet the price today changes a lot when the cost of financing changes. That's not because the kitchen got better overnight. It's because the discounting of the future changed. Equities are doing the same thing, just with earnings instead of rent. And once you see it that way, a lot of AI fear talk starts to look like a proxy for something else. When rates are rising, investors become allergic to uncertainty. They demand a higher price to bear long-dated risk, and they get picky about what they own. When rates feel calmer, investors don't need the same level of defensiveness. They can tolerate ambiguity. They can rotate. They can widen their bets. It's not that they suddenly stopped worrying. The cost of being wrong just feels different. That's why the market can act as if AI disruption risk is less immediate without any deep new revelation about AI. A friendlier discount rate backdrop can make the market treat disruption as a slower moving risk rather than an urgent one. In other words, the timeline of fear stretches out. The market stops paying up to hedge one narrative every day, and it starts looking for places that were left behind. There was also a twist in the flow read that points in that direction. Beyond pure tech, money was reported as going into areas like industrials and metals and mining. That matters because it looks like breadth. It looks like the market trying to express optimism through multiple channels, not just one concentrated story. When flows start to spread like that, you often get a different leadership feel. Fewer only these names work days, and more multiple things can work days. Put that into a regime frame. In an AI disruption risk regime, leadership narrows. Investors crowd into a small group of perceived winners, and everything outside that group gets treated as vulnerable or irrelevant. Breadth weakens, rotation becomes defensive. In a rates and sentiment relief regime, the market can start to broaden. Investors stop paying an extra premium for the same handful of certainty stories, and they start buying what they avoided. That doesn't mean AI stops mattering. It means AI stops being the only lens. This is the narrative gap. Headlines describe a feeling, while prices describe a constraint. The feeling is less scared. The constraint is how expensive is time and how expensive is risk. When that constraint loosens, you can get a risk on tape even if nobody has actually solved the AI debate. So when you hear AI fear is cooling, you can translate it into something more testable. Ask, is the market actually repricing AI fundamentals, or is it repricing the discount rate and the overall risk appetite? The first would show up as persistent dominance of a small set of AI-linked leaders, even as the rest struggles to keep up. The second often shows up as a more even market, with rotation into other sectors and more participation outside the usual suspects. Now, two stress tests keep this defensible. The first is the inflation and rates stress test. If inflation reaccelerates, yields can rise, and the hurdle rate rises with them. In that world, long-duration equities are the first to feel it. The same market that looked comfortable can suddenly look fragile, not because AI changed, but because the discounting of the future changed. That's why this regime can flip fast. It doesn't require a new AI headline. It can be triggered by a shift in rate expectations. The second stress test is AI specific. Even if rates stay calm, a fresh shock that revives AI disruption fears can re-narrow leadership. That could be a narrative shock about how quickly AI profits can materialize, or a shock that makes investors doubt whether the spending cycle is translating into earnings power. If that kind of fear comes back, the market often reverts to a familiar pattern. A smaller set of names gets rewarded, and the broader rotation fades. So what do you watch to know which story is winning? First, watch the next inflation prints, and more importantly, what they do to rate cut expectations. You're not trying to forecast CPI in your head. You're watching how the market updates its view of the hurdle rate. If one inflation print can erase the idea of cuts and stocks stumble, you're in a discount rate-driven regime. If inflation surprises don't change much, or the market shrugs them off, then something else is doing more work. Second, watch mega cap breadth versus rotation. If the largest names keep carrying while the rest stops joining, the market is quietly narrowing again. If the market keeps finding new leaders outside the mega caps, the broadening is real. That's the simplest leadership thermometer you can keep in your pocket. And the takeaway ties it together without hype. The inflows tell you investors are willing to take more risk today. But the reason matters. If the reason is discount rate relief and sentiment thawing, it can be undone quickly by a shift in inflation and rate expectations. If the reason is a genuine AI narrative reset, it should show up as persistent leadership changes and a different pattern of who gets rewarded. Pivot watch is clear. The next inflation prints and the next read on mega cap breadth versus rotation. If those two diverge, treat the headline explanation as suspect. Risk on flows are less about AI is safe and more about a discount rate and sentiment regime that can flip with the next inflation surprise.